from the town that I love best. Talk Memphis, I wish you would. Talk Memphis.
Today we're talking about Dan and Butler and I. Dan, welcome.
Good morning.
How are you?
Good. How are you?
You know, I'm fine. I'm excited about today's show. Let's just dive right into it. It is Becoming Bankable, the 5 C's of credit. You know, we have a ton of investors that will pay cash, but we also have just as many, maybe even a few more that are borrowing. Yeah. Whether it's one house or one multifamily unit, or if they're doing a package loan or what have you, they're looking to borrow.
And at some point, the people with cash are going to run out and need to borrow, or I say need, if they want to keep growing, they're going to have to leverage.
That's right. That's right. So today we're going to get into the 5 C's of credit. Those 5 C's are character, capacity, capital, collateral, and conditions, and we're going to break these down.
Yeah, it's funny. Practice what I preach. I met with a banker yesterday afternoon, kind of give him an update where we are, trying to loan a little bit of more money and just talk through that process. And I was telling him about the radio show last week and the response we got with local banks. Yeah. He was very appreciative, but I told him about the 5 C's this morning. He's like, would you believe that 85% of bankers cannot name the 5 C's?
Really?
Like this is like the foundation of how you underwrite. Yeah, this is what we're about to share today is the foundation of what we underwrite.
Yeah, you didn't create these 5 C's. This is what bankers use.
That's what bankers use. We're just going to articulate with stories and how we look at it and how we've, been able to utilize it for, the last 15, 20 years, in our relationship with local banks. Yeah, 85%. He's like, and even him, he couldn't name the exact words. He named 4 out of 5, and I did too. I was like, well, I better figure out that 5th one before the show today. But
right,
and just the fact that I started thinking about that. I was like, on the flip side, if you're an investor or want to be an investor, and you really learn these 5 C's and understand the makeup of these that we're about to go through today, like you're going to sound and come across to your banker as so, you know what I mean, like well-versed and knowledgeable and wise, and just you've done your homework, you're educated, you got to, you should be able to, I always call it create a story. You should be able to create a story of within each one of these 5 C's for yourself of how you handle character and how you do the capacity and what you're doing about the capital and, all that stuff. So,
well, let's dive into it. The first one's character.
Yeah, man.
To me, it's, a lot of people say, just not even dealing with banks, but a lot of people say your credit score, not even if you're applying for a loan, but your credit score tells a whole lot about you as an individual. If you're, and maybe you're not maliciously going down this path, but if you're somebody that does not pay your bills on time, your credit score is a reflection of that. Yep. It's also a reflection of you in most
your priorities and how you're running your business, your personal business.
Yeah, most instances. I mean, there can be that one-off to where something happened unfortunate, and this person's actually a good borrower, but they ran into a hard time. But typically, I would say 90% of the time, your credit score is a good indication of your, I'd say, business tendencies. Yeah,
and I would also just take it a step further, and it was good having this conversation with that banker yesterday because he's one of my favorites in town. We have a good relationship and very, very knowledgeable. His whole family's in banking, but his point was I don't even look at the credit score so much as the meat behind the credit score. Right. You know what I mean? Like, right. Like mine is not the best in the world. I'll be the first one to tell the audience.
You've told me this.
And because of all the loans we have and all the business we do, they're constantly checking my credit to make sure I don't have anything crazy out there. You know what I mean? Like that I'm not doing something crazy on the side or, buying boats and all this stuff on credit and living this lifestyle of,
that you're not supposed to.
That I'm not supposed to based on what's going on in my life. And so I get dinged. It's going to be hard for me ever to get to 800, credit score.
Because it's annual, right?
Most of banks are annual, but if you do 5 or 10 banks,
you're getting 5
or 10 times, right? So just, everybody needs to keep that in mind. So he doesn't really look at the credit score as much as the meat behind it. Like you said, are there a lot of late payments? Are there, is it healthcare? Is it student debt? What's the makeup of it?
I've always heard bankers tell me that student debt is the biggest crutch for a lot of people.
Yeah.
Because it stays on their credit for so long.
Yeah.
And the balance goes down, but it goes down so slow that debt stays with them and hampers them from doing anything else. Borrowers track record for paying debt, reputation created, on time, 100% of the time. Sometimes, I mean, that's what you're saying. They're going back and looking for. They're actually looking for a payment history. You know, what are your tendencies every month?
Yep.
I've always been, I don't know why, but for some reason, and I've got a great score, but I've always been super paranoid about it. I don't borrow a lot of stuff. I have, some personal debt, a house and a couple of car notes, and then business debt, we've got some houses, but outside of that, we don't have credit cards. We don't have stuff like that we carry all the time. I mean, we'll go on vacation on one, but my point is, we don't carry a $10,000 and $15,000 credit card debt all the time.
Is your wife's higher than yours?
Yeah.
Mine is. Leah's is, yeah. And I'm like, what in the world? You're not doing anything like out there in the, it's like, doesn't do anything to have credit, but
Dan, do not say you're not doing anything.
Yeah. She's running the home. She's home operations manager. You're exactly right. That's a full-time job.
My lovely wife member that she didn't do anything. No, I
in the business world, that's what I meant. Putting her name on documents and signing her life away.
Yeah,
I do that. Like,
I take that stress.
I take that stress. I try to keep
we
that
let
off
them
of.
go to Target.
Yeah.
All right. So bank use, the banks use, they and this is all credit bureaus typically, they use Experian, TransUnion, and Equifax. Mm-hmm. They take, most people know this, most people don't, or some people don't. They don't ever take the low and they don't take the high. They take the middle.
Right.
Whatever the middle score is from Experian, TransUnion, or Equifax is typically what they use.
And I don't know the difference. That's something probably I should dig in. Like, why do you have three, and what are they looking at? Do you know?
Yeah, a little bit.
Okay.
But not into, I probably know enough to get in trouble.
You're working the system.
I'm working the system. But when you go to a car lot and you run your credit, your credit's going to score higher. They value it higher. I don't know why. I think it's because you're borrowing less, and I think actually more people have to have a car, so the credit scoring is a little bit easier. If you go get a mortgage, the credit bureaus are way tougher. Now, I don't know which one of these is more geared towards the car lending and the mortgage lending, but those are the two most popular things that people go and run their credit for: a car and a house.
Yep.
So one of these is a little bit more lenient towards the house, and one of these is more geared towards a car. Because I went and ran, I bought a car last year and ran my credit and heard it. And I was like, wow, that's a little higher than what I thought. And then the guy there explained to me, hey, these are a little bit different. So yes, your bank's going to be looking at that, but from what I understand, mortgage companies and banks, they take the middle, the middle score of the three. So, how much do you borrow? How well you paid it, the debt? Those are some things they look at. All of this that's going to show judgments and liens. It's going to show bankruptcies, balances that are due, and it goes back about 7 years.
And part of this, with character, I think I would suggest people have some sort of alert system on their credit, or ask the bank for that copy once a year. I think I had a banker call me one time. And I think you've heard this story before, but he's like, hey, man, your credit score is down like high 600s. What's going on? And I flipped out. I was like, what? What are you talking about? And apparently a hospital, I got this idea from another person, by the way, that I had an MRI. And I was like, I usually pay things as we go. I don't like to have that kind of debt. But I was like, they said, well, just put on a payment plan. I'm like, okay. So I put on a payment plan. Well, unbeknownst to me, they put on a collections agency as part of their process. The bank, the hospital.
Oh, just automatically, no matter if they're paying it or not?
Yeah, it's part of their process. I'm like, what? So it goes to a collection agency. So they dinged, showing me this debt. And so, I'm scrambling. I'm like, hold on, let me get that fixed real quick. So I literally went to the actual hospital.
And paid it.
And I want a form. I said, give me a form that shows me that I'm paid full, clear, that I can report to the credit agency. I mean, it took me a month to clean that up. And then it went above 700 and something,
See, what I understood is that if you made payments regularly and on time to them, that they couldn't do that. A hospital or medical or something like that, if you make a payment, that they can't send it to a collect. So you automatically, no matter you no payments whatsoever, they automatically send it to a collection.
In this case, they did. I don't know if it was a mix up, or I didn't stick around to find out. I just got it off my credit, But, you know, and then another story comes to my mind, you know, one of our peers in the industry, you know, he had built some condos downtown and went in with a guy and, you know, I heard more of the story yesterday as I was talking through this, you know, and then the recession hit. And one of the other partner just went, you know, belly up and just fled town, you know, but our buddy, you know, stuck it out with the banks, was very transparent. Hey, look, I chose to get into this. I can't help what, you know, he did and what happened to this development, but just tell me how we can work this out. And literally, I think he paid like $7,000 or $8,000 a month for like years
to try to recoup,
to pay that debt off. You know, he could have, you know, the other guy filed bankruptcy and fled town and, you know, try to start over somewhere else. But I mean, to me, that summed up character. You know what I mean? He had integrity. You know, what do you think that bank that the banks that he dealt with, when they hear that story or they are involved in that story, do you think they're going to keep lending to him?
Oh yeah,
absolutely.
No, they know they're going to get their money back from him.
You know, that a local bank. I mean, I think character is actually the number one piece.
Yeah.
You know,
what kind of business they run and how they acted in their
how they handle, you know, how they carry themselves, not just in, you know, their debt, but how they run their business and how they treat their employees. And, you know, they're going to watch all that stuff. So our listeners need to understand that, you know, the bankers are like, you know, you're being interviewed
every time,
all day, every day, you know, what you report, you know, how you're reporting it, you know, are you trying to, you know, get one by them, you know, just be open. Yeah. You know, even if it's a bad situation,
tell them about it and how you're going to fix it. That goes a long way with anything, really.
Right. As long as they know, you know, but they don't want surprises, you know.
Right. Never. Like non-payments.
Right. You know, on the character side, I mean, people just went dark.
Dan, I got stories of bankers that told me, Dean, I'm at my desk. It's 10:30 in the morning. I'm enjoying a cup of coffee and we're banking. And a guy walks in with a Ziploc bag full of keys, drops them on the desk, and he walks out.
That's better than not answering the phone.
It's better than not answering the phone. But my man took in, our friend Tully told me that he was sitting in his desk in South Haven and he had an investor that they bank with, and he had a gallon-sized Ziploc bag that had, 20 or 30 sets of keys in it. And, of course, they'd been communicating and talking to him, but he came in and tossed them on Tully's desk and said, I'm done. He literally said, I'm done, and turned around and walked right out of the building.
That's funny.
That's for the records. And he'll tell you that story next time you talk to him. But, yeah, came in, tossed the bag down, just waved at him and said, that I can't do this anymore. I'm out. You imagine, hey, I tell you what, that person's a fun person to talk to at that moment. Oh yeah, because they will tell you, it's like truth serum almost. They will tell you anything and everything you want to know. They will tell you exactly how their experience goes and has gone. And I mean, if you want truth, you get that person right then. Wow. All right, number 2 C's is capacity. Yeah. Measures a borrower's ability to repay a loan, compares income against recurring debts, and it assesses a borrower's debt-to-income ratio. Yeah, the DTI. Banks talk about this all the time. That's DTI, the first thing they debt-to-income ratio. So, you know, most scores, I guess that's what they go to. Yeah, they're going to look at your income that you have, and they're going to look at the assets you're buying, and then your global. They really want the asset to have a 1.1 or 1.2 ratio, meaning, you know, after you pay the debt and all your expenses, that you've got a cushion of 10 to 20%, basically what that boils down to in layman's terms. You know, when you get bigger and bigger, they will start looking at global, you know, make sure your job, you know, you could buy a property that has a lower debt to service, and then your job, you do so well and you keep your personal finances so low that you can cover it globally. Does that make sense? Yeah. Like, so they're going to start looking at, you know, you from a global standpoint at some point, but they're going to want, you know, that 1.1, 1.2, 1.25, just depends on the bank, you know, and how conservative they are. But so how to achieve this? One of the biggest kickers of this is what people don't think about is to keep your personal expenses low. You guys just heard me tell you that my wife and I have got a mortgage and 2 car notes. We don't keep. I don't have a boat. I don't, you know, have a whatever it may be, you know, credit card debt or whatever people carry. But that's been huge from the bankers that I've spoken with. They've all said, "Man, that's excellent." You know, build your business portfolio. And then eventually they can start loaning you on your business, but they still take your personal assets into account, even when they're loaning on your LLC. So keeping your personal expenses low. What's some of those other ones? How to achieve that? Yeah, just, you know,
pay off your credit card every month, keep that debt just for like operating expenses. Like for me, I just use it as a way to security, versus swiping a card and taking it out of my personal account. Now somebody has that number to my personal account. I just use a credit card and use it for like transactional, and then pay it off every month. I mean, don't carry that debt forward. You know what I mean? Like don't.
Yeah. It's a good habit to get into. Just don't, and sometimes people do it with American Express because I think, and there's a program with them where you have to pay it every month, I believe.
Yeah, yeah, and just show that. Keep the debt as low as you can on all your personal side. One of the things that we did early on was Dave Ramsey's system, kind of a tangent to this, like where you envelopes and we pull out money every month and it's allocated to certain expenses, and once that envelope's gone, it's gone. So that you got to come up with your own personal system to keep your personal expenses low. I think, Rich Dad Poor Dad and books like that talk about this, as you're getting your W-2 income up, and you're working this and you're buying real estate, like just incrementally change your life. Don't try to go from a 2,000 square foot house to a 5,000 square foot house. You know what I mean? Like, just fix your 2,000 square foot house or add on.
Because I see it every day.
Yeah, you see it all the time. People just, keeping up with the Joneses kind of, like, the other ones keep liquid assets. Cash, stocks, your 401k helps on your personal financial statement, but that they're not really going to count that. I don't know if people know that, but that's not really going to go to your capacities side of the equation. It's going to look good because it knows you're saving and doing, but you can't access that money real quick.
No.
You know what I mean? So
without a huge penalty.
You need cash. One of my friends that bought, he did really well, bought 10 houses slow and steady. And then he got, aggressive one year, bought 10 in 1 year, and he just collapsed because he had no reserves. Mm-hmm. Every penny was in buying these houses. Mm-hmm. And so, you got to think about that. Like when you're going through this, and that's part of this capacity question. They're going to look at your global and say, does he even have, if you have $500 in your checking account, and nothing in stocks or nothing in CDs or anything like that, like, it's going to be hard to get a loan.
Very.
Like it's going to be tough. So keep all that in mind as you're building. You're going down that track, thinking about being an investor or building to the next level. That's part of this whole equation for you.
And you can build this. So this is something that you can build and work on. You're not stuck. Your initial capacity outlook can change. It can also go down. Mm-hmm. Right. I mean, I guess naturally, the more you add, it's going to go down. Mm-hmm. The more you take care of your home, the more you take care of your portfolio, I think it could level off, where they'll keep loaning to you. But just by naturally, when you start borrowing, you begin to go down unless your income, is just steadily rising and going up.
Right.
But one way or the other, it's got to give. So that's capacity. Go ahead.
And the only thing I'd say is you're basically, in summary, you're mitigating the probability of default. You're trying to reduce, to the bank's eyes, you're trying to reduce that probability. If the house goes south, or you had 2-3 bad months, or no rent for 3 months, or an eviction with $5,000 in repair, or whatever, that you're able to sustain through there. When you first buy it and there's a tenant, everything looks rosy. You gotta, hope for the best and plan for the worst.
That's right.
That's kind of the whole point on this. You're preparing yourself for the worst, not for the best.
Talking to the 5 C's of credit today. How to become bankable. We talked about character. We just discussed capacity. Mm-hmm. Next C on our list is capital.
Yep.
How much money is the borrower willing to put towards a potential investment? That's big. Small banks want to be in the game with you, right? I mean, or they want you to be in the game with them. Mm-hmm. They want some skin, they call skin in the game. They want you to, because I'll tell you this: I've had partnerships and I've seen partnerships. I haven't been in many partnerships really. I just haven't. They never seem to work out.
You don't work well with people?
Not particularly, no. No, it's usually my way or the highway. But
that's right.
No, I've seen partnerships develop, and I just don't. You've got to both be in it. If you have a partnership where the person's coming in and they're putting in quote sweat equity, and you're the one using all the cash, they do not care as much as you do. It's impossible.
Right.
It's impossible. As much as they say they do and they act like they do and they want to, they don't care as much as you do. If you've got all the cash in it, you're the one that's not sleeping well at night.
Right.
Now, they might be stressed to get a job done, but it's a job. Right. If they're not actually have cash in it with you, then they don't feel nearly the pressure that you do. So banks feel the same way. You know, they want you to have that. How much money is a borrower willing to put towards it? They want to know that right away. What are some of the other things that when we talk about capital that you think of?
You know, just they're just looking at how between your capacity and now you got your capital. They're just trying to lower that chance of default. And so, part of this whole equation, this gets into a really interesting discussion that could lead into a whole nother tangent, is just buying it right.
Yeah.
So there are ways to not have as much capital in the game, and there's ways to, circumvent the initial 20, 25% down, conversations. But if you're a traditional investor working behind a desk, attorney in LA, kind of, guy that just wants to put money to work.
My favorite investor.
So they're going to want to put 25% down.
Yeah.
You're not going to work. They don't want to work hard to try to figure out, buy and refinance and all that stuff. I mean, they're going to look good to a banker, I guess is the point.
Yes.
The $100,000 house, and it's probably worth 110, and they're going to put 25% down, so it's 75 for 110. So the banker looks at it and says, okay, if he just walks away tomorrow, and that's what my banker friend yesterday is like. We're talking about us loaning money. He's like, if you need to look at that house and borrow only what day one, he just all of a sudden he closed, and the next day he's like, where'd he go? Where's Waldo?
He's gone.
He's gone. What do you do with that house? Can you do something with that house without losing money?
Yeah.
That's how the bank is looking at it. So that's why that capital piece. So, as you're thinking about investing or taking it to the next level, start putting that money to the side that you can use. Now, I would argue, and argue is not the right word probably, but, debate, keep that money to the side and then try not to use it. If the bank will allow you, if you buy it right.
That's me.
That's me too. I mean, I try to buy it right and work with the local banks to refinance it and try to get close to 100%, but I also can show the bank, look, guys, I need to keep this $50,000 or $25,000 or whatever that number is that you want to share
for a rainy day.
For the rainy day, for that hey, when that water heater goes out, I'm not having to worry about.
Yeah.
I can still make that mortgage payment to you, Mr. Officer, bank officer, because I got this reserve. So but it goes back to character. They need to see when you start laying this story out. People need to understand as we're going through these 5 C's. All this needs to tie together. Your story needs to stay consistent. Stay true to your word. Do what you say you're going to do. So that needs to happen.
I've heard a little trick. This little trick that I heard a guy tell me one time that he did when he had a bank that wanted him to put 20% down, and I don't remember the exact numbers, but let's just say it was a $100,000 house. He didn't want to put the money down because the house would appraise. It was appraising for 140 or 50 or whatever it may be. But the bank said, "Hey, look, we want something. 20% down. 15. We got to do something." So what he offered them, and they did this. It was a local bank. It wasn't Wells Fargo or whatever. He just said, "What about I put $15,000 in a checking account in your bank? Leave it there in your bank. I'll use it for this house when I have things that come up. But you can see that money is there. I'm going to put it in your bank. I'm going to use that bank account as the operating account for this asset. As I grow, maybe I can get that money back out and keep going. But I want to assure you that I'm in this with you." Now, they went for it, and they said, well, because it appraises so high, you are willing to put this money into the account here in our bank. We'll go ahead and loan it to you. So essentially, he had to take 15 or 20 grand out and put it in that bank, but he could go get it whenever. So it was something that just made, this is another reason why I say go with local bankers, go with guys that are banking, because they can make decisions like that. Like Wells Fargo's not going to do that for you. Citibank's not going to do that for you. They don't care anything about that. The local bankers can look at that and say, hey, this guy's character is good. I see on all of his history here, he's paying his debts.
Right.
He's got 5 houses already. Those are clean. He's doing that right. His mortgage, his credit card, whatever he's got, he's paying. He does have a good deal here. I understand where he's coming from. he was willing to put this money in this account, so let's loan him the deal.
Yes, I love that you brought that story up because I totally forgot. We did that same thing back in 2014, I think.
Yeah.
Bought a big package locally, and the bank had us put instead of the money down, we were like, man, we don't like to put money down. We had a second with the owner, which was awesome.
Yep.
But we had to put a significant amount of money into the bank account.
Yep.
And we couldn't touch it for 3 years until the loan paid down a significant portion. Because we put on a 15-year note, and we just had to wait for that time.
Do they have a penalty for you if you took it out?
They wouldn't allow it. I mean, it was locked.
So it's essentially the same thing. This is a little bit different. This guy just put it in a checking account, and he used it as an operating thing. So, I mean,
okay.
Yes, he could.
Do you have a minimum? Do you have to keep the 15 minimum or no?
No.
He just had to start with
They
15.
just said, put the 15 in here. We're going to go with you on your word. Yes, you can come in tomorrow through the teller and come grab it all right back out.
But they're watching your character.
But they're watching your character then. So that's kind of what he leaned on when he said that, one of the reasons why they did that, the C's that we're going over.
Yeah.
Credit, his capacity was there that he could take this on. His character was good that he talked about. So when it came to capital, they not bent their rules, but they were a little bit more lenient on him on exactly how that money came as a down payment to him.
Yeah, and I think, again, the banks are just thinking about the worst. Like, are they going? Yeah, what?
That's
if we
all
get
they were
sick?
thinking about. That's all they were worried about was, is he going to walk out tomorrow?
That's right.
Well, if he does, we got a home that appraised higher. We got some money in the account
bank,
right here.
Right. They can lock that account.
They can lock that account up if you can't hear him. That's
right.
exactly right.
I'm sure they put those in the loan docs.
The loan docs. We'll lock this thing up. There's some different ways that you can get creative with capital, but the last one we're going to talk about is collateral.
We actually have two more.
Oh,
Conditions.
Yeah. Oh, that's right. I'm sorry. Collateral and conditions.
Yeah.
Look at me not looking at my notes correctly.
That's all right. I missed that too.
Collateral and conditions. So let's talk about collateral. What is it used to? It's obviously what you're using to secure the loan. If you go get your traditional mortgage in your home, the collateral is the home itself. But when you go out on a secondary borrowing, not spree, I don't want to use that word, but borrowing mission or whatever, you've got to have some kind of collateral. Typically, it's the house, of course, that you're borrowing on, and then what you're going to put up. If it's an unsecured loan, a secured loan, the better the deal, the more willing the bank is to loan on it.
Because they've got to sell that to their board, their committee, so. And it goes back to that one little story I told last week, like where the collateral, the bank just didn't feel good about it. The actual asset we were looking at buying,
they didn't like it.
So,
which is their prerogative, right? I mean, like some banks. How often? Let me ask you this: how often do you? That's a good question. How often do you find the bank is going to check out the asset?
Most of them are just going to look online, Google Maps, look at their tools they use to look at values. They don't really, until you start getting, multiple properties
or $1 million property
or $1 million worth of property, multiple houses or a big apartment.
Yeah,
they're definitely going to drive those. One-off houses, not so much.
Now, a hard money lender, we've talked about this before.
They're going to look.
They're going to look at the property. They don't care nearly as much about you
the person.
as they do the property.
Yeah. All those other 5 C's are out the window. They're just looking at the collateral, the asset.
That's right.
We call it asset-based lending. That's all that is.
Mm-hmm. The better the deal, the more willing the bank is to loan on this. The quality and the stability of the property. We've got B neighborhoods, low crime. C neighborhoods, a little bit higher crime and no jobs.
Yeah, think about. You hear enough, and you've helped enough people now in the last couple of years. Like, how willing is a bank to loan to a $25,000 house in Lawrence Mound? They're not.
I don't know banks that'll do it.
No. And it's interesting because it kind of plays into, most banks will tell you they don't want to mess with something under $50,000, and they use it as it's just too much work for not enough money. Yeah. But at the same time, they also know that the saleability, resaleability,
it's harder.
They're going to loan you $25,000 on a house in Orange Mound, and when they take it back, or if they have to take it back, they might could get 10 because there's no investor out there.
The investors are salivating over that.
They're going, I'm not paying you 25. Yeah. I always joke, one of my bankers, one of my good friends over at First Alliance, he always jokes with me. He's like, why is it every time you bring me a house is worth 50 and I bring you that same house is worth 20, 15 or 20? I'm like, well, that's just name of the game, man. What are you talking about? Yeah, it's just the conditions that are happening at that time, that the collateral's just worth more, when I bring it to you than when you bring it to me. So,
Yeah, that's right.
so yeah, I think, I think when a bank sees you, because it ties into the character, the debt, that's the collateral, was it the conditions, I believe, the capacity. If they come to you with a house that you're trying to buy, that you're wanting a loan on it for $80,000, and it's worth 70 or 80, or
used to do that.
Huh?
They used to do that.
They used to do it, or they'd buy it for. When people ask me like, what was the difference back? How did I make it through the downturn? The biggest thing that I saw was just that we only wanted to loan what we owed for the property.
Yep.
And so banks are real leery of people that are going in there and they try to buy a $40,000 house, put 10 in at 50, get it appraised for 90, and try to get 80% of 90, 72,000. They want a check for $20,000.
Man, that was a big game.
That was a huge game.
That was a big game in what, 15 and 16?
No, back
earlier than that?
Earlier, yeah. Like I'm talking about late 2000s.
So 2008, 9, 10.
Yeah, before the crash.
So that's 6, 7, 8 before crash then.
Yes.
Crash was 8, 9, 10.
Yeah. So what happened was people would take that 15, 10, 20, and that was their living money.
Golly,
and
man.
so, when they took that collateral and they over leveraged it by just leveraging it to the hilt, you essentially, when that game stopped, well, guess what happened?
Yeah.
Property tax stopped being paid, maintenance stopped being performed, and then you're in an uphill battle because that interest rate on property taxes, isn't it like 18% or it's sky high? So if you don't pay your property taxes, there's huge penalties. So then you can't. Then those guys could never recover because the banks swung the other way and stopped. And so by taking your collateral and leveraging it the right way, you can be more successful in that. You know what I mean? Like it works better. So
one of the main things too with this collateral that we've talked about and in our notes here too, we've had a whole show on this, but buying it right. I've seen. I was sent a house in an area yesterday that I love it. I saw the address, saw the house. It's like, man. And the guy wanted 55 for it. It's like, ugh. I didn't want to pay over 41. Now I looked at it. I looked at the pictures. It's like, there's no maintenance.
It's good to go.
It's good to go.
Yeah.
Everything looks great. I just couldn't do it because I'm not buying it right. You know what I mean? I couldn't pull it. Now, if he was around 42 or 43 on it, then I'd have already, had it under contract. But I couldn't bring myself to do it because it's just not buying it right. I've lived by it. I haven't bought enough homes to have a bad lesson on that yet. Where I bought something wrong and knocking on wood or whatever this material is made of here. I'm trying
Formica.
I'm trying not to ever have that happen. Everything I can, and I'll ask you, hey, would you? Perfect example, that 3-house package in that area. That man, we
you kept trying to get me to tell you to buy it.
Dan, tell me to buy this thing, because it penciled out great.
Oh yeah,
penciled
out
great. Good, but the area, you just there's so many things that factor into buying it right. And if you stick, I think, to sum up a little bit of this, the 5 C's here are important. I think buying it right has all of these encompassed in it.
Yeah, I mean, oh, absolutely. Yeah, that's a great point. I think it's going to sum up everything for that banker. If you can buy it right and you're showing your due diligence to get there. So
we got one more. Talk about conditions.
Yeah, I mean, conditions, the last one. I mean, conditions, you're going to look at what's the current market. I mean, big picture.
Big picture stuff.
Market conditions, are, what's the interest rates? What's your amortization? What's the economy looking like? What's the job rates? You know what I mean? Like
how many deals does that bank have under their portfolio?
That's right.
It's their condition too.
That's their condition. You know, what's the percentage they have for rental houses?
Yep.
I mean, you've heard Tully talk before, like, hey, got to put the
halt,
turn the faucet off. I've got to, you give me enough. So all those conditions play into, and then you got to understand. So we talked about that a little bit last week, where each bank's conditions and the way they look at the conditions is a little different.
Yeah.
Because each bank, especially local, so I mean, we're, a Jackson Bank,
Yeah.
a Memphis Bank, West Tennessee Bank. Each bank has a board that's made up of certain individuals with a history from new construction to manufacturing to
Accounting.
rentals to accounting, and that accountant may have been specialized in a certain type of real estate. So that board is going to have a flavor of what they like and what they don't.
Yep.
It's not a right or wrong answer. That's what people don't understand. They get frustrated sometimes.
If they get denied from a bank, that bank might have way more single family homes than they want to carry, and it has nothing to do with you whatsoever.
No, it's you're bankable. We talked about last, with these other C's, but
we're just not
the
interested.
conditions that the market, they see it. They have economists. They deal with economists. So you got to understand that when you talk to your local bank, you don't want to go into, you don't try to put a square peg in a round hole.
Yeah.
Go to the bank, find out what that board makeup is, find out what their appetite is, find out how they look at deals. That, because that bank officer you're dealing with is going to have been before that board or that loan committee dozens and dozens of times.
Yep.
So you start learning people's patterns, what they're going to challenge you on. That's one of my favorite bankers is what they can tell you. Like, they help you shape the story.
Yeah.
To prepare you for what they're going to present to the bank.
It goes back to last week's show too about local banks and how to use them.
Right.
I mean, and I know this is kind of a series that we're running here, but if you go back to last week's show and listen to this week's show, you should be able to, correlate what we talked about last week into this week and have them kind of combine, because you're looking at what the bank wants. Sum up for me before we go, the 5 C's of credit in about 15 seconds.
I think to me, it's on the banker side, it's looking at the borrower.
Yeah.
And how all the different ways they're slicing and dicing us. Mm-hmm. And then on our side, we need to think about how they're looking at us and then reacting and creating a plan, a story, a process to cover those 5 C's so that when we go to the banks, we're bankable.
You're checking. Man, that's it. You said it all.
Becoming bankable.
As Howard Stern says, you've said it all.
You said it all.
All right. Hey, thanks for listening. We appreciate you guys. We'll be back here next Tuesday on the Memphis Real Estate Hour. We'll see you then.